Welcome all. Phil, let's kick it off with you. What did we learn today?
Well, Kelly, what we learned is that Delta still is very optimistic about where they're seeing the consumer as we head towards the end of the year. Let's talk first about this narrowing of the guidance in terms of full-year earnings expectations and free cash flow. Yes, Delta did narrow its expectation after increasing it just a couple of months ago, now expecting to earn between $6 and $6.25 for the year. Previously, the guidance was $6 to $7, so a little bit of a narrowing there. Free cash flow, $2 billion for the full year, was previously expecting to bring in $3 billion. The reason for these changes, higher jet fuel costs, and they'll really see that in the fourth quarter, as well as higher maintenance costs. In terms of bookings, Delta likes what they're seeing right now with the consumer. In terms of domestic and international travel, there is still robust demand there. Corporate travel bookings are increasing. So we asked Ed Bastian, do you see the consumer slowing down at all? Here's what he told us on Squawk Box.
We in the industry do see it in certain parts of our industry on the lower fare side of the business, but we're a very different carrier than those. We got premium, which is continuing to drive the strength of the business. We've got international, which was gangbusters.
And as you take a look at shares of Delta, keep in mind that the other story that we asked Ed Bastian about that is not getting a whole lot of attention today, but it will over the next couple of weeks, is the changes that have been made to the Sky Miles frequent flyer program. They announced these changes to make it more restrictive, Kelly. That was, 3 or 4 weeks ago. Immediate backlash. Ed Bastian said a couple weeks ago, okay, we're going to make some changes. We'll tweak it again. I asked him this morning. He said, we're not quite ready. We'll hear about that over the weeks to come.
All right, Phil, because we have you, got to ask about this surprise expansion. Surprise to me, at least. The UAW, for once, doing this midweek at this Kentucky Ford plant. What's the significance?
Well, this is Sean Fain of the UAW keeping the automakers guessing about when there may be strikes and where there may be strikes. And in this case, this is a gut punch to Ford because this is a huge and extremely profitable plant for Ford. The Kentucky truck plant is where they build the Super Duty F-Series trucks, the F-250 to 550. Those are huge profit drivers, along with the Expedition and the Lincoln Navigator. The company's 8,700 UAW workers at the Kentucky truck plant, they walked off the job last night. This plant is responsible for just under 20% of Ford's U.S. production. And in terms of overall strikes by the UAW now in the United States, there are 33,000 Big Three UAW members who are on strike. All of these plants, by the way, as you take a look at this, I think it's up to 44 plants. Most of them are parts and distribution centers for Stellantis and General Motors, but there are 6 final assembly plants in there, including 3 that are operated by Ford. The ripple effect of this, as you take a look at shares of Ford, Stellantis, and GM, Kelly, we've seen now more than 5,000 workers at other facilities that are not on strike that the automakers have had to lay off because of the ripple effect, because either stampings aren't needed, parts aren't needed. The work is not happening because certain plants are on strike. And I suspect we will see those layoffs increase over the next couple of weeks.
Ooh, all right, Phil, thank you. We appreciate it on both fronts, airlines, autos. Phil LeBeau.